Well, hello there, everybody. Michael Silva. The business cycle is taking a turn, and copper and gold is revealing some shocking insights. So in this video, we're going to talk about why these metals are key indicators for the business cycle in the stock market. We're also going to get into some key levels in the S&P 500 first in today's Stock Market Brief show. If you haven't done so already, make sure to hit that thumbs up. It's greatly appreciated. Let's get into it. All right, everybody, welcome back to the show. We're taking a look at the S&P 500 on the daily time frame. We got the weekly expected moves there in the dashed lines. The pink lines are just some very magnetic levels in the S&P 500, and those levels happen to be 4,200 on the upside, where it's acted as support and resistance multiple times, and then 3,900 to the downside, which is acted as support, resistance multiple times, as you can see. Actually, most recently, we got under 3,900, as you can see here. We came up, we back tested 3,900, and then we started pushing far away, and it looks like we can climb to around that 4,200 in time. We'll see if we can get there, but that is very similar to what we saw here, how we broke 3,900, but price came up. It back tested, and we saw an explosive move into 4,200, and then it got rejected from that level. So price action, it's been very choppy, but these last 4 days or so, it's been on a pretty strong run. Now, going into tomorrow, we got some daily expected moves to keep an eye on. I'll explain why these are so important. It's really the market looking forward as far as, hey, what is the relative range of risk going into tomorrow's trading session? And this is not me putting numbers on a screen. This is actually a calculation derived from implied volatility. And I'll show you why it's so important on today's price action on the Qs. But what I want to point out here first is the S&P 500. So as we stand here, where we haven't touched the weekly expected moves yet. Tomorrow, the daily expected move to the downside is 408.32. To the upside is 413.58. We're above the week to date, quarter to date, month to date, right? It's all the same thing. As far as the anchored VWAP goes, and you can see today, really, we kind of came down, and all we did was contract throughout the day. A lot of chop. And this was something that I looked at earlier in the trading session, coming right over here. And the reason why I looked at this was because we were staying beneath that daily week-to-date anchored VWAP. And I was looking at this as basically saying, hey, if we can get price back above there as price is contracting, you know, bears should definitely watch out because you'll probably get some sort of a push. We definitely did get that push up into the close. We're still above that inclining 5-day moving average, so the bulls still have control. So you look for dips to potentially buy. That was some of an opportunity there. If you take a look at the Qs on the 15-minute time frame, so this was the daily expected move that we got and we looked at and tracked today. Right, I shared this with on the weekly recap brief, and you can see what happened. Well, price gap down, right? We kind of flagged around. It was looking pretty bullish, holding the anchored VWAP for the day, and then we cracked down through it. And where do we come to? We came to the weekly expected move, and we just hung out there all day up until the point where the S&P 500 really broke through the anchored VWAP, or the daily VWAP. The Qs ended up following, and that really helped propel that move forward. If we take a look at tomorrow's expected move for the day, it's 322.78 to the upside, 317.52 for the downside in the S&P or in the Qs. We're still above an inclining 5-day moving average, and we still, as you can see, we haven't really moved anywhere for the week, and we still have a wide open range there for the remainder of the week. Now, the big news today was oil prices making a big surge. The jump followed a vow by Saudi Arabia and other OPEC Plus members to cut production, and you can see here we just saw this explosive move to the upside right past that 50-day moving average. So we couldn't get it through, right? We couldn't get above it during the cash session, but you can see it cleared it there with that news. So this bear flag that we're looking at was holding its structure, but today we saw a big move. Now this is a little bit concerning because when I look at this and then I look at something like copper was down on the day. It was down 1.2% on the day, so it got hit to the downside. And you could see that there's typically a correlations that I track between this and the S&P 500, but more on that in a second. When I take a look at oil relative to copper on a 15-day period and a 30-day period, you can even go out further, but the majority of the time, you can see that it remains at a positive correlation. So the fact that oil was up so big, but yet copper didn't even really track at all is a little bit, odd. Now, this could be because we had some macro data come out, and this is the United States ISM Purchasing Managers Index, the PMI. We just had our fifth consecutive 5th straight month of contraction in factory activity. So you can see the 50 line. Once it goes below 50, we go into contraction. And that was the 5th month and the lowest of those months too as well. So we're just diving deeper into that recession territory. Keith McCullough pointed out this on new orders as well, taking a seventh month of contraction and the second weakest print of the cycle. He did mention all good for gold and TLT, which we will actually discuss. Now, the reason why I want to show you this specific chart here is because there are some indicators that we can use to potentially give us a head start. And this is something I pointed out on prior videos and even on Twitter. But if you look at something like the copper to gold ratio, right? Copper is known as Dr. Copper. It's an economic metal, right? When it's thriving, the economy is doing pretty good. All right, and then gold is more of a safe haven asset. So when I look at this line and it goes down for pretty much the entire year of 2023, it's telling us that gold is outperforming copper. And that means the safe haven asset is outperforming more of an economic thriving type of metal. And when I look at this 10-year chart, let me go back. I always do that. When I look at this 10-year chart, what's very interesting here is if I just pull side by side this and then the PMI, this and then PMI, this and PMI, you can see right here, there's these three, these three peaks right here, and they track very, very, very well. So if you're watching this and you start to see the line go down, you can typically see that, hey, this might actually make a turn. And we were talking about that back over in this area a while ago. Now, if I take a look at something like gold, take a look here how it's really contracting, right? This thing looks like it could potentially is set to explode, right? So it just actually had its highest close, if I see this correctly, highest close on the year. Yeah, on the year. Yeah, so 2023 right here, boom, it just had its new high close. It wasn't its highest print, but it did have its new highest close. So this thing is, it goes from expansion to contraction. You can see higher lows. So either this is going to take a little bit of a breather, consolidate more, or this thing could potentially explode. And if that's the case, and you look at something like copper, and copper's going down, well, what do you think is going to happen to this line if gold outperforms copper by a wide margin? You're going to see this start to decline even further, which is just potentially leading us to believe that economic conditions could very well get worse. Now, why do they call it Dr. Copper, right? It's market lingo, all right? And if I just scroll through this, you can see this makes copper price a good leading indicator for economic cycles. Well, what's an economic cycle? Well, if you take a look at this sine curve, right, this is the business cycle, the economic cycle, and you can see multiple stages within this over here. And while it goes into contractionary phase, right, contractionary phase, there's an asset that does pretty good, and that's typically bonds. And what doesn't do good? Well, stocks and commodities. I haven't even talked about, oil going up and how that can potentially even hurt the Fed's positioning even more on inflation. That's, we'll say, for another day. But this is why bonds could be a potentially good a place to start looking. Now, during this period, we already stated that when we move into contraction, there are a couple of assets that do typically good. So as we move into a potentially full-blown recession, the blue is the business cycle. The assets that do typically good from a relative standpoint is technology, communication services, discretionary, and industrials. And the stock market has been actually following that, telling me that, hey, a stock market bottom might be very close in time, but it might not be very well close as far as price. We don't know that because you got to understand, if we get a full-blown profit recession, well, what could happen to potentially these top performing sectors that are already up 20%? Well, say if they get cut in half, right? What if XLC goes to 10% up for the year to date, and this goes down to technology? What if this gets hit all the way down to up 3%? Well, I'm sure other sectors are going to feel that pain, but yet they can still be potentially top performers, and we could still be trying to find our market bottom. So you just got to be well aware the difference between that business cycle and the stock market cycle. So as I'm seeing it take place right now, and I've stated in other videos, what I see as far as potentially good assets, gold has been performing quite well. We talked about this rising wedge. We talked about adding over here, and now it's really just consolidating. So this thing looks strong. We'll continue to watch to see if that's the case. Copper, I want to go back to copper really quick because the divergence that's building. Now these red lines on the screen, this is when copper has a lower high, and I'll just show you the most recent one. high, lower high, and we got this hit down today, and then we have this high in the S&P 500 to a higher high. That creates that negative divergence, and it has been a pretty decent leading indicator for us. It doesn't mean that it's perfect and the holy grail, but I mean the last one that took place was this right here, where the S&P 500 kept ripping up higher, but yet copper wasn't confirming that move. And you can see what happened here with the S&P 500. The last bear market rally, the big one, was over here, and you can see we saw S&P 500 continue to just rip up higher, but copper couldn't make a new closing high up here, just giving us that indication that, hey, we might see price pull back. Now this also works on the flip side of it for bullish divergences. You can see we had this, I'll say the market current market bottom. We don't know if it's going to go lower, but you can see copper hit a low and higher lows where the S&P 500 was putting in lower lows. So copper was signaling to us, hey, maybe it's time for the S&P 500 to rally. And you could see here we did rally, create another divergence, and rallied some more. So just some interesting charts and interesting data that I wanted to share with you. If I show you a chart of TLT and why I think it looks good as well, first and foremost, look at all the moving averages. This helps us just visually see a trend, right? You can create trading strategies with them or whatever. I like to use them to really just visualize trends. And as you can see, this was all bearish, right? You had the big 200-day that was above the 100, which was above the 50, which was above the 20. So it's basically in reverse, and it's flowing, nice spread, and just pointing straight down. And you can see price followed, right? It came up, it broke down, it came up, broke down, and all these bear flags all the way through. What's taking place now is a little bit different of a story. Now we're starting to find a base, and the moving averages and the trend are starting to compress, and they're starting to flatten out to go to neutral. So we could be very well in the early stages of this period where bonds start to outperform the greater market, which means this is something that you'd probably potentially would want to look into for a cycle type trade, adding in for a long exposure, and then trading around it however you plan on doing that. Now, as it stands, right, we're kind of contracting here. It was up pretty big on the day. So, yeah, it's going to take some breather space, right? This 110 area seems to be a pretty heavy area of resistance. We kind of broke out. We're back testing all these moving averages here. So, it could take one crazy event where we get a flood back into bonds. It hasn't really happened yet, but hey, keep that open, at least open-minded for the possibility for something like that to take place. If we take a look at the 10-year yield, right? So if yields go down, bonds can go up. This is just sitting here at this prior level of support and resistance. You can see it was once resistance, and then it started acting as support multiple times, and we're right back to that key level. So you can see we have a high, a lower high, a lower high. This was actually kind of a higher high there, but a lower high right there. So, this kind of looks like it could be potentially topping here, where if we start really breaking down this level, that sends us down, and that could very well send bonds out of this kind of trading range. So that is one thing that I'm looking at. If we take a look at the yield curve just keeps getting deeper inverted, except for the 10 and 2. The 10-year 3-month, I mean, it's not great. It's not healthy, right? We're down 147 basis points. We're minus 54 basis points on the 10s and 2s. And typically when we become uninverted is when, typically bad things happen in the market from these deep inversions. So we'll continue to track that. Another big asset to watch is obviously the dollar. It's still here. Like, it was actually looking pretty strong on the day today as the market started off on little rough footing or whatever. But I would just keep tracking this, because if we do start breaking out with the dollar, it has a very strong negative correlation with the S&P 500. So this could very well mean, even if the S&P 500 points up and gets up to 4,200, which we priorly discussed, the dollar could potentially bounce at some point here, right? And even potentially break this down sloping trend and really send us for a tailspin there in some equity markets and other various markets as well. If we take a look at the BP-NDX chart, it is now moving into that overbought condition. Remember, these oscillate between overbought, oversold, and overbought, and oversold. And you can see while they do that, we find some sort of sub-bottoms, and then we go up, we find some sorts of tops, and then we find some sorts of bottoms, and then we go up and we find some sorts of tops, consolidates, and so forth. But that's not the only one. We have BP-OEX. Right, this is very similar to the Nasdaq 100 in theory, because that it's using the S&P 100 cap weighted. It's looking at the big dogs of tech, but you can see there it's in that overbought condition there. And then BP S&P 500, RSI is not an overbought condition as it stands right now, but it is trucking itself up there. Probably will be up there within a day, 2 days, maybe a week. And then the last chart I want to just close off with is, even though the market has been rallying and you want to follow this bullish short-term price momentum, which is totally fine, but you still need to be very cautious given the context of many different things taking place from the background. But this is the percent of stocks above the 200-day moving average. And as you can see, as we're kind of moving higher on the Nasdaq composite, look at the percent of stocks that are actually above the 200-day moving average, 33%. 33% as the market is trying to move itself higher. Just earlier this year, we were at 55% were above it. So it's telling us that, hey, very few stocks, it's very a narrow leadership within this entire composite, within this entire index, which is also a little bit of a warning sign there too as well. That's all I got for you on today's episode, everybody. Hope it gave you some insights for tomorrow's trading day and some other stuff as well. Bye.